Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, February 18th, 2016. I'm starting this video at 8:37 Eastern Time, so that's about an hour before the markets open. And what I'll do is touch on U.S. equities, gold, maybe currencies, because that affects where gold's going, and real quickly touch on oil at the end. There's just been so much going on in the financial markets lately, so much movement, and so many developments that I've reverted to doing a lot of these video updates. It's just it would be nearly impossible to really touch on all the charts and the salient developments in the markets by via static post, to handwritten typed out post with charts. So let's try to get through this relatively quickly. Not a whole lot has changed. If you've watched any of the recent videos or been in the trading room, I've kept my thoughts pretty consistent lately. This is the 60-minute SPY. This was covered in the recent market update video. Mentioned, the divergences. We had these shorter term divergences with the purple lines here, positive divergence. The larger divergences noted by these lines below. Prices making, this double bottom here in the SPY. And these were the previous targets, these T1, T2 zones. Those were hit on the last time we, went long at the bottom there. Those were the targets put up at the time. And if you look at this, take all that away. These are just all my annotations, charts, Fibonacci retracement levels, things like that. But let's just take all that away. And from a simplistic view, take a look at what's forming here. And what we can see is this, what looks like a W bottom. You have this line leading down there, this move up here, another low, and so far this W-shaped bottom. So if we were to simplistically, let me just draw a line here. Let's say that's the top of the pattern. And there is a potential that if we break out above that pattern, we could have a considerable move higher. Right now, I'm not favoring that. And even though we have a lot of, like I said, divergence in place, that is possible. I mentioned yesterday in the trading room, I've been, what I referred to it as cautiously bullish now for, a little while, looking for this upside. And yesterday I closed out a lot of my long exposure. Mentioned a lot to do with a gut feel, but more so that the charts just aren't clear. We have some conflicting information. So, I went through last week, spending the bulk of that video, or the most recent market video, I should say, making the bullish case for a near-term rally that will possibly carry, or quite likely carry us into the end of this week for options expiration. And some of the reasons I cited in that video were the fact that we had these bear flag patterns on the daily time frames. Just about every index you look at, the SPY, QQQ, IWM, mid caps, they all had these very nice looking bear flag patterns which were foiled, and that was my expectation that these might become foiled, and if so, that would be a very bullish technical event. Fewer things are more bullish than a failed bearish breakdown. This was not just a pattern that was set up, it actually broke down, and that's where textbook traders shorts pile in, longs exit when they see a bear flag breakdown, if they're watching this kind of thing. And so far we've had a very impulsive move, gap, gap, gap up. And that is what you expect when you have a foiled or failed bearish breakdown. So why my hesitation? Well, let's jump over to look at the bigger picture here. Okay, these are my quad. It's what I call my quad trend indicator layout. I've covered this quite a bit in the past. I have this short-term trend over here, several indicators. I have some custom EMA histograms that I've created, different pairs that when those EMAs make a bearish crossover, the histogram goes red, indicating the short-term trend is bearish. Also, a very simple view is the 20 EMA, the blue line here. When prices are trading below that, the trend is bearish. So we have gotten above the 20 EMA. So there's one potential near-term bullish sign. But if you look down here, you just see red, 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 red. Yes, there is divergence. I could draw it out here. You see the histogram making a higher low against prices making a lower low. So you have bullish divergence. And, again, I'm not shorting at this time. I'm just reducing long exposure. I didn't close all my longs, but I definitely want to lighten up here because this trend is still bearish until those cross over. And remember, don't trust divergences. Don't trust bullish divergences as much in a bear market or a primary downtrend as you would during a bull market or a primary uptrend. The same way that bearish divergences, bearish chart patterns have a much higher failure rate or chance of playing out at all in a bull market or a strong uptrend. So that's my mindset here. This is what's given me pause, and I have no problem going to cash, even if this market runs up and the SPY and the Qs move another 5, 8%, 10% higher. Right at this point, you can see here as we move to the left, my intermediate term trend indicator, and that is still solidly bearish here. Let's see if I can expand this. Control. So you can see how deep in the red this 50-20 EMA pair, and I pointed this out. These pair, the 20 and 50-day exponential moving average, when they cross, that's done a great job in the past, or just about as good a job as any on that time frame of defining primary trends. At least the intermediate term trend. And you can see that the 20 EMA, this green line here, is well below the 50. And that's also represented by this histogram right here. That's all that histogram does, is just give you a visual on the the differential between those two lines. Okay, move up here. We'll look at the what I call my weekly trend, defined by the 43 and 17 EMAs, and this one's done, well, again, a phenomenal job. These have all been covered in the past. I've showed history on these going, even this is a 10-year chart here. We can even go past that, and it's captured the bulk of all the major trends in the market, and as you can see, clearly bearish. So again, all I'm doing is making the case here that the charts in the short term continue to look bullish to me. And indicate more upside. However, I'm skeptical of bear market rallies, and because what happens is they usually tend to fail right as they look like they're getting going, and the reversal can come out of nowhere and hit you hard if you're positioned heavily long. So again, just not worth the risk and reward to be aggressively long at this time. Although, as I mentioned, and still do, we've got another day, 2 days today, throughout today and into tomorrow before options expire. So, I still think I think we might see the markets. In fact, there's a good chance, almost I would put it much better than 50-50. We'll see the markets go red between right now, they haven't opened yet on Thursday, and sometime tomorrow. They've gone up so much in the last few days. Excuse me, I'm coming off a chest cold that I've had here for the last week or two. So that's that. Let's just keep an eye on it. And the longer term trend, as you can see here, this is my longest term trend that I have. And that is solidly, these are some of the different indicators that I use, a 10-6 EMA pair done again. You can go back as long as you want. This goes back to the mid to late 80s, and you can see every major bull and bear market, this indicator has told you when the trend was bullish and when the trend was bearish. And I talked about these. When you go out to longer term trend indicators, they don't get you in as early as the shorter, faster indicators, but they do have a much better track record as far as whipsaw signals, much fewer, if any, whipsaw signals, I really should say. There's one right there, but then that wasn't confirmed by the ROC 13. So again, I've covered these in the past, so I won't go over them anymore. But you can see now we had that confirmed sell signal in January with a monthly close. So far, yes, we have a couple weeks to go in February, but we're solidly on sell signals there. So once again, my skepticism as far as the the bullish developments that I'm seeing in the shorter term time frames. Okay, now let's move over to gold. I know there's still a lot of interest in gold in the mining stocks. I did an extensive video on those too. What was that, yesterday? I just put one up. So I won't spend too much time. Take a look at that video. Most things were covered. What I'll point out here is, I've been calling for a pullback in gold. Started calling for it much too early. We were in a parabolic run. We had these gaps, but we did get it. We had one heck of a pullback if you really look at where gold topped out last week and the pullback. Now here's something I've noted. And I'll roll into the currencies because currencies play into this a lot. But you can see here, I put up this Fibonacci retracement level from the lows to the highs. In gold, you can see pulled back. There's the highs right here, that candlestick on, what was that, Thursday. And then Friday we had the down day and then a nice gap down. So that left this island cluster that I talked about, island cluster top, and that has potential longer term bearish implications. By longer term, I'm talking weeks to months possibly. So I'm on guard there for some more downside in gold. But look what's happened so far. We're right at just below the 23.6 Fibonacci retracement level. So in other words, gold has retraced just over 23, call it maybe 25% or so of its move up. And we look at GDX. Now the miners are, as I always refer to, what I call a leveraged play on gold, only because they tend to move up more percentage terms when gold's moving up and down more in percentage term when gold drops. Just to their business model and what the price of gold, how it affects their bottom line. Now look at the miners only pulled back. As you can see, they're still above that 23.6. If you follow over here, this is the dotted line. I should probably take that off. Maybe make this a little more clear for everybody here. Forget about the other lines here. I'm just trying to find a clean board, and so this is what I was trying to highlight here. This is the move up, and I have to add that 23.6. There we go. It's typically the minimum fib retracement level, and so that's what we've gotten so far in the miners. The minimum, pull back to that first fib level. Remember, gold went more than that. Now, normally you would see the miners pull back, at least in percentage terms. Sure, it's in. Or I should say, in relative to the Fibonacci pullback, relative to the move that they had up, and we haven't seen that yet. So gold GDX has actually held up a little bit better than gold, and one of two things will happen. Excuse me, one of two things will happen. It'll either play catch up to the downside, which I still think is the most likely scenario, or this speaks to really the underlying fundamentals, the underlying bid right now. There's no two ways to slice it and dice it. The bid has been strong. This correction has been bought up, as I said, more so than the correction in gold, the pullback in gold. So really, ultimately wherever gold goes, the miners will follow. So as I said, we had that some bearish developments on gold, such as that island top on the daily chart here. And then I mentioned the weekly chart. Now we have 2 days left to go this week. Here was that downtrend line. I jumped over to weekly chart, I'm doing this fast. There's that downtrend line I've been watching forever and a day. And, we took it out last week, closed above it. It made a solid intra-week breakout, managed to close above it. But so far all week, every day this week, we've closed above that level. 2 days to go, so anything can happen. And, again, I'm not betting anything hard. I haven't had any official trade ideas on gold or GDX in a while, but I do still favor some more downside, especially if we can't close the week. And longer term charts, as I mentioned and continue to reiterate, look bullish. It'd just be nice to see maybe one more pullback, some consolidation to build up the energy for a more lasting breakout. These kind of breakouts rarely stick, from my experience, when you have the RSI move from near oversold to overbought levels in just one fell swoop like this. Those kind of breakouts just don't keep going. What happens is, maybe at best we flounder either above or below that trend line. Pull back to that 112 level would be great. There's some support there. Maybe consolidate for a few weeks and then have a more lasting breakout. But again, we'll take gold as it comes. Let's look at the currencies real quick. I was really covering these quite a bit recently. This is the euro. Let's go to the 60-minute chart. This is a chart I've posted for actually we were up in this wedge. We had this whipsaw signal, this false breakout. I thought that might be where we started the correction in gold, but we whipped back up, went within the wedge. As I mentioned, put another divergent high, and we did, and I pointed out the breakdown when we got it. So this breakdown, and this is really where wedges typically break, around this point, this 70 to 80% or so to the apex of the wedge. And so that was a beautiful clean breakdown. That one stuck. came back tested, you can see just right there, and has moved down. And this was a target zone I've had for for a while now. And so far, look at this is today. And remember, these currency pairs trade in pretty much in real time around the clock. So we've had a perfect kiss of that. So what does that mean? Well, we've now hit the bottom of my pullback target zone, so the odds favor a reversal, and that's actually bullish for gold. For those of you that, if you're not familiar with why I talk so much about gold and watch about the currencies when I'm trading gold, well, I just overlaid this blue line as gold, and you can see euro, US dollar. So this is really the euro moving up against the dollar. When this chart is going up, the green and red bars, candlesticks, that's the euro going up against the dollar. In other words, a falling dollar. And you can see almost perfect lockstep with gold. So right there was the top. And as I pointed out, that would be likely the top in the euro, especially once that bearish rising wedge pattern broke. And you can see gold topped right there along with the euro US dollar pair and has moved down since. So now lately, the euro took that last leg down and gold really hasn't. See, gold's held up. And yeah, I think that's largely the fact that those in the know trading gold do what I do, and they watch these currencies to give them a heads up on where the metal might be going. So if you look at this, if we can get this MACD curled up here to start to point up, confirm this bullish divergence. When I'm talking from prices in the euro US dollar pair making a lower low versus the bullish divergences down below, then we're looking at a likely reversal here in the in the euro, which means dollar down. So now we're not there yet, but if we do, we're looking at a bounce, and that should be net bullish for gold. However, if this level goes, support is support, and you often get at least reactions on the initial tag down from above. Now we had a reaction off the top of my support zone, my pullback target zone, but if this level goes and these divergences give way, we could move down. And this is the next support here. Let's go out to a 2-hour chart. Okay, you can see it a little bit better. So we could have another thrust lower. And in fact, I'm not crazy how this divergence looks on this 2-hour chart. So I'm open to the possibility of more a downside in the euro, additional upside in the US dollar. And again, just in gold and the miners, just like I am in the equity markets, let's say I'm cautiously bearish on gold and the miners, meaning that I'm not going to bet anything hard. That's why we don't have any official trade ideas and haven't in a while. I just think the risk reward is absolutely awful right now for going long on the miners, even if there's a little more upside. They're just way too overbought, and I see too many things on the chart that shows that at best they'll probably be dead money for a little while. And dead money, keep in mind, in the miners, if you're holding them, you're going to get chopped to pieces. Those suckers move up. The GDX 5-6% in a day is the norm lately, and then add that in if you're trading dust or nugget. And if you can't take those 18-20% daily swings, for or against your position, then you shouldn't trade those. That's especially when the charts aren't that clear. So that's the currencies, and again we'll watch this pullback target zone right where the euro is, where it hit the lows today, the euro US dollar pair. And if that level goes with conviction, especially a 60-minute close below, it gets pretty thin. By thin, I mean you can see this yellow line is a nice support level, numerous reactions here, and all we had is this quick punch up. So a thin zone, this area between the bottom of my pullback target zone and the top comes in around, you can see 109,878 down to about 109,736. That's a thin zone. Thin zones are comparable to gaps, where as if prices just shot up and never traded there. And thin zones, just like gaps, tend to be backfilled once entered. So if the euro gets down here much more, the euro US dollar pair, we're probably looking at a backfill, which would mean dollar strength, which would mean gold and GDX down. But again, case can be made. Divergence is in place, and we are at support. So I wouldn't do anything right here. Part of what gives me the pause and I should say open to the possibility of more downside in the euro US dollar, even though we've hit my target pullback zone, is I had mentioned back in the videos done recently this flag pattern. Now there's a lot going on here, but you can see these white lines. We had a breakout in the euro US dollar pair, and when I'm looking at a daily chart here, so I measured up. This is the flagpole. This very unidirectional, nearly vertical move up. We had a period of consolidation and then a breakout, and I had mentioned at the time I expected there would be a good chance that that breakout would fail. I showed you what the measured target would be, and that's what technical traders would be looking for, a move up to here. It's a nice, resistance level in the euro as well. But I was eyeing that 60-minute chart and that bearish rising wedge pattern, which did play out. And so what that happened, just like in the indices where we had the foiled bear flag breakdowns, here we had a foiled bull flag breakout. That sounds like a tongue twister. Bull flag breakout. So that's what's happened. We've come back to the bottom where the flag was, and these things can have longer-term bearish repercussions once the bullish pattern is foiled or a bullish breakout is foiled. So that's why I'm looking for the possibility of more downside. Simple but effective MACD crossovers. And just go back and you see when the MACD crosses bearish. Right now we had a bearish cross recently. Bearish crossovers in the MACD are often are followed by more downside. We are testing that 50 level, which often acts as support when tested from above initially. You see back here, we tested the 50 level bounce, tested the 50 level bounced, finally broke below it. So there's another support, 50 level catching support. Sometimes we trade through it once we break above it, but these initial moves when you come up from this overbought reading down to the 50 level, that often provides support. So yeah, I'm giving mixed signals here, and all I'm saying is I'm not trading. I wouldn't take a position in the currencies, and I do have still a short trade put on the miners, which I'm giving some more rope than usual, but I think that'll play out, and I see somewhat limited upside in the miners right now. At best, like I said, maybe a consolidation here for a while to digest the recent strong run-up. Okay, we'll wrap it up with oil. I know oil's been a big mover lately, and a lot of buzz on oil. I'd still think, I've been saying it for a while, these positive divergence in place on both the weekly charts. Look, that's a daily chart right there of USO. Here's a weekly chart. Bullish divergences in place. Extreme oversold readings. So longer term, this looks bullish. Was this the bottom most recently? Maybe. There's been so much buzz. It's almost comical. Everything you've read in the last few days about Iran's not going to be on board. Now they're on board. Oil's rallying this morning. I'm talking about the production halts. This is what I'm trying to get at. This is right now a news-driven market. Yes, there are technicals involved, and this is a line to watch, and we're probably going to punch through it. I'm looking at my other one of my other screens right now. USO is trading at 905, 907 as I talk. So, no, that's not going to do it. We're going to open right, because this would be today's candlestick. This chart that we're looking at, it does not reflect pre-market trades, so that's where the crosshairs are, just above that downtrend line. So, any minute this wedge can pop. You can see that we're getting close to that point in apex. So I wouldn't short off that level, but I would definitely not go long right now, because we're going to, if we open where I'm looking at right now, we're going to open right up into resistance, which is that downtrend line. So, a pop above it, especially a daily close, might work. And if you want to start scaling into a position long, I think one of the best options is to take a very small position of the DWTI, the 3-time leverage crude short ETF, and you could short that. That way, if crude oil moves around for a couple months, breaks out, comes back tests, and it takes a while to really form more of a basing pattern here, that decay would work in your favor. So like I said, don't, if you're going to trade UWTI, which is a 3-time long crude, that's good for a day trade or maybe a couple days, but not weeks or months. There's also 2- and 1-time levered. This is USO, and they also have OIL. If you don't want to use leverage, and then of course there's crude futures and everything else. So, anyways, that's crude. Like I said, bullish, but I'm just leery right now because this is such a news-driven market, and these news-driven pops and rips and dips can be pretty big. So, but I do see some nice setups in the energy sector, and I'll follow up with those. Once again, a lot of trade ideas. I posted For every official trade idea I've put up on the front page lately, I've probably had three, four, or five, or if not more, within the trading room, and some of those are playing out nicely. They're unofficial trade ideas because we do have these mixed signals in the market, and I'm keeping it light. So I'm trying to keep the official trade ideas as some of the more solid-looking setups. But that again, uh, check out the ones in the trading room. If you see a pattern you like, I usually put notes with it, and you can ask me questions if you have any questions on those unofficial trade ideas. Okay, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.